Be an expert with our how-to videos for real estate. Here's some tips on the loan process.
Hi, I'm Joe Massey, Senior Loan Officer with Castle & Cook Mortgage, and today we're going to be talking about conventional financing and how conventional loans can help you purchase your new home. So on a conventional mortgage, generally the minimum down payment is going to be 5%. Now you can of course put down more money if you want to put down 10%, 15, 20%, 25% or more depending on your goals. But an important number to keep in the back of your mind, similar to FHA, on a $200,000 home, that 5% minimum down payment is going to be $10,000. If you're looking to buy a larger home, you're going to need to have more money down, or if you're looking to buy a smaller home, maybe a little bit less money down. Now, if you don't have, that full 5% down, we might sit down once you get your property under contract and do a comparison between a conventional loan and FHA and see which one makes the most sense for you. Now, another important point on conventional loans is you will have monthly mortgage insurance. There are some options that you can have mortgage insurance on a monthly basis. You can pay it up front one time at the time of the closing, or there's an option called lender-paid mortgage insurance, which we can cover with you as well. The important point is if you're not putting down that full 20%, you will have mortgage insurance in one form or another. Now, a lot of folks call me and say, Joe, I want to find a way to not pay monthly mortgage insurance. Perfect. That's exactly what conventional loans are designed for. We're going to talk to you about putting 20% down. So if you're buying a $200,000 home, you need to be prepared to put down $40,000, or if you're doing a refinance, have at least 20% equity in the home. By doing this, you're not going to be subject to the mortgage insurance restrictions on a conventional mortgage. Another important point with conventional is interest rates. Interest rates are very low right now, but they can vary depending on your credit score, depending on how much down payment you're putting down, depending on the property type, and a number of other factors. Whenever you're watching television or you're reading the newspaper, you're always going to see interest rates advertised as the very lowest available interest rate for the very highest qualified borrowers. So keep in mind, if you have a little bit of a slighted credit score, if you've had any challenges in the past, if you're not putting down that full 20 or 25 or 30%, you may have a slightly higher interest rate. Again, part of what we're going to do when we meet with you is sit down, go through those options, cover with you the pros and cons of conventional versus FHA, and exactly where you're going to be on your specific loan program and terms. Another important point on conventional loans is maximum loan amount. For a single family home, you're going to be at a $417,000 maximum here in the Denver metro area. Again, in some counties, there might be some higher loan amounts. Eagle, Summit, Vail are going to have some higher loan amounts. If you're looking at buying a second home in those areas, call us. We'll be happy to go through those options with you. But generally, $417,000 is a good number to keep in the back of your mind as the maximum loan amount that you can get on a conventional mortgage. Now, an important distinction is that loan amount is different from your purchase price. So a lot of people call me up, Joe, I want to buy this $500,000 home. I want to look at a jumbo loan. Well, actually, you don't necessarily need to. As long as you can put down enough money to get you to a $417,000 loan amount, you can get a conventional mortgage, and the difference between the loan amount and your purchase price is simply going to be your down payment. So we help a lot of our clients take advantage of that $417,000 maximum to get the lowest possible interest rates, but still be able to buy the home that they're looking at for $480,000, $500,000, $550,000, depending on their goals. With conventional mortgages, you also want to be aware of the minimum credit scores required. The minimum credit score on a conventional loan is going to be 620. However, once you get below about a 660 credit score, you're going to see pretty hefty charges added onto your interest rate and your closing costs to make up for the risk of having that lower credit score. Well, one of the things that we're going to do when we meet with you is go through your credit report with you, and we're going to compare an FHA loan versus a conventional loan, and depending on your credit score, you might find if you're in that 640 to 620 credit range, an FHA loan might make a lot more sense for you than a conventional loan, but we're going to help you with that comparison. On conventional loans, another important distinction is ownership types. You can use conventional loans to purchase a primary residence, to purchase a second home, or to purchase an investment property. So if you are looking at purchasing an investment home or investment property or second home, generally conventional financing is what we're going to be talking to you about, because it's going to give you the most flexibility and have the most options for you to get approved and have good financing terms. Also important on conventional loans are the property types that you can finance. Similar to FHA, you can finance a single-family home, a multi-unit property for 2-unit, 3-unit, or 4 units. You could finance a townhome or a condo. Now, on condos, there is not an approved list like there was on FHA. There is simply a review that we're going to go through of the Homeowners Association, that we're going to have the Homeowners Association fill out a questionnaire, provide us with some documents. As long as they meet the minimum requirements, that Homeowners Association can be approved for conventional financing. An important point on conventional loans also is the seller paid closing costs. The seller can contribute up to 3% on a primary residence and up to 2% of the purchase price on an investment property towards your closing costs. These can go towards paying your processing costs, your title fees, your homeowner's insurance, any of the costs that you're going to have associated with purchasing the property. The seller can actually help you with these items so that you can focus on bringing only that minimum down payment to the closing. So to review the pros and cons of a conventional loan, the first big benefit is going to be, again, minimum down payment. A lot of folks think you have to put 20% down to qualify for a new conventional loan. It's not accurate. You can actually put down as little as 5% to qualify for a new conventional loan. Conventional also gives you the option to opt out of mortgage insurance. If you're paying at least 20% down on your down payment, you would not have to have monthly or upfront mortgage insurance. Also, conventional loans are going to be very flexible on your ownership type. You can purchase a primary residence, second home, or investment property. Of course, the interest rates are going to vary and the down payment requirements are going to vary depending on the property or the ownership type, but still very flexible terms there. The downsides on conventional, again, 20% down. If you want to avoid mortgage insurance, 20% down is a lot of money. Depending on your goals, you may not have that or may not have as much as 20% to put down. We may have to look at a 5 or 10% down option. You will have the mortgage insurance if you don't have that full down payment. And interest rates can vary on a conventional loan depending on the property type, your credit score, down payment. There's a lot of variables that go into that. So depending on your individual qualifications, we would want to just compare that a conventional loan makes sense for you and is the best option as compared to an FHA or other loan option. So thanks for joining us to talk about conventional loans. And please feel free to come back while we talk about other lending options in future videos. Thank you.